Hello and welcome to the Mutual Fund Show. I'm Niraj Shah, and we'll talk about some of the most useful insights from the mutual fund space so that you can make the right choice when it comes to your investments. Kickstart the show by getting in a special guest, Vishal Kapoor, to try and understand how he thinks about, one, the current market landscape, but also about two or three very specific things that they are doing at Bandhan AMC as well. Vishal, great having you as always. Neeraj here, thanks for taking the time out. Good having you.
Great being here, Niraj. Thank you.
No, the pleasure is entirely ours. Vishal, we did a small study this morning about how, if you look at 2009, 14 or 19, and the ensuing 5-year period has resulted in about 50-55% gains at the very least. From 2019 to 2024, it's been about nearly 88%. Suffice to say that investors should brace this volatility and actually use this volatility to their advantage as opposed to letting go of the investments in the mutual fund space?
I think investors should look for gains, and gains are driven by earnings growth. So while, of course, volatility is an important factor, and especially at times like this when there's a lot of news flows and a lot of, and clearly day-to-day, volatility we're seeing, that's exactly the time when you have to anchor back and say, what do I really want from my investments? And keep in mind that you started with a certain objective with a longer term horizon. And it's important now to remind yourself that don't get swayed in by taking knee-jerk reactions. Stick to your objective, stick to your goal. And if we have, hopefully, you've got a lot of returns coming through because of the gains from the markets over the last 4-5 years, you should continue and not let this volatility disrupt what you were setting out to do.
Okay, Vishal, what are the SIP trends that you're seeing at Bandhan? Because we've seen different AMCs come out and obviously so. In some cases, there have been slightly different than what even the AMFI trends have been. So what is your sense, and is there a perspective that can be gleaned out of how investor behavior is, or especially over the course of the last 6 months as we come closer to the big event?
So a couple of trends that I would call out, not just for us, but across the industry as well, because we are a participant in the same market. First is the explosive nature of the growth. And sometimes, when we look at the data month on month, we may miss out of how dramatic the change has been. So I was just looking at industry data recently, and as in just to think about just 1 year back in April last year, we were averaging about 20 lakh odd new SIPs into the industry every month. And the AMFI data that came out for April 24, just a few days back, is now showing a number of 63 lakhs. So, in 1 year, we've moved from an average of about 20 lakh SIPs to about 63 lakh SIPs. So while, yes, the headline has been SIPs are growing, the scale and the momentum that we have in the industry with number of new SIPs, I think is probably captured some of, in some of these numbers, which is almost 3x in just a year. Clearly, at an aggregate level, there are very impressive numbers in terms of overall SIP, growth in the industry. So, for example, live SIPs are up about 37%, monthly SIPs are up about 43%. So, very, very healthy numbers in SIPs. The second trend I would call out is how the young generation, the Gen Z, and the do-it-yourself investors are taking on to online platforms to do their investments, to do their SIPs. So as a proportion of the overall pie, we've seen that over the year, both in Bandhan as well as in the industry, the proportion of do-it-yourself investors, whether it is coming directly to mutual fund sites or whether it's going through fintech platforms, has gone up. So direct and fintech-based customers used to be about 1 in 4 about a year back. Now it's becoming 1 in 3 in the overall pie of new SIPs that we're seeing. So that's another trend that we're seeing, that many investors are choosing to come online and directly invest. And the third is the product mix, where in the industry we've seen, not necessarily only in Bandhan, but in the industry we've seen that increasingly investors seem to be more comfortable in choosing SIPs with higher risk investment ideas. So for example, the small cap space or the thematic and sectoral space, even mid cap for some extent, as a proportion of overall SIPs, we've seen this proportion go up slightly faster than the aggregate of these three buckets in the industry. So clearly, some investors and maybe a smart strategy to use SIP as a way to reduce and buffer the risk in otherwise higher risk categories like small caps or thematic. So that's the other thing that we are seeing, maybe for different reasons for different investors, but something that may not necessarily be very unhealthy in a sense.
Okay. Well, so people are taking high risk bets, Vishal, and I mean, you launched in such a period of time a multi-asset fund as well. I believe this was in January. Now, I would love to understand for somebody who is willing to take that little bit of risk, if not extreme risk, is multi-asset a good category to be in, or would you rather stick to a pure equity category?
So to us, multi-asset is always a good category because and I think most distributors, advisors, most seasoned investors will agree that the importance of asset allocation is something that cannot be ignored. And when you have periods of time like we've seen where one part of the market really just gallops ahead, you can sometimes miss out on the risk management component of your portfolio. And that's exactly the time you have to take a step back and consider, is this the amount of risk you can actually absorb in your portfolio? And the multi-asset plan or the multi-asset strategy, which fundamentally is leveraging the power of asset allocation as a strategic thought, is something that can help you through market cycles. So the idea of the product really is that, invest through a longer term approach, invest into something where you can really almost invest and forget it type of approach, because the manager, the fund is actually doing the rebalancing between the various asset classes over periods of time based on certain principles. The idea there is that you actually, over a long period of cycle, may be able to achieve very similar to market returns without necessarily taking the type of risk that the market or the volatility that the market would have otherwise been subject to. And that's something we are seeing borne out also in the performance of the scheme over just a very short period of time. But investors would have benefited not just from equity going up, but also, as we've seen over the last couple of months, gold and some of the commodities have rallied. So that's again a portion of the portfolio that has done well. So the idea really is a similar return with hopefully lesser risk that allows you to stay in the fund much longer. And that, I think, is a principle which should be highlighted at times of volatility as a bit of almost a caution, if I can call it, to make sure that you're not getting ahead in your expectations versus what the market can deliver over a long period of time.
It's an interesting mix of assets that you have within your fund, Vishal. What are the kind of returns that an investor can anticipate if one were to do a lump sum or an SIP? I mean, SIP would be XIRR, but what are the kind of returns to be anticipated, roughly?
So, Niraj, as you know, there is no absolute return
or
any return prediction. But I would say that if you're invested long term and long enough, I think our studies have shown that the return range tends to be maybe a few hundred basis points around the long-term equity averages, but at much lower levels of volatility. So it's really a fund which allows you to stay longer because you're not as worried with market volatility. And we've seen, and studies have shown over long periods of time, that market volatility forces investors to get in and get out much too often than what is necessary. And it's exactly that sort of behavior that this fund allows you to manage better.
Okay, well, launched in January. Vishal Kapoor says it's nearly an all-time fund, or always a good time to invest in multi-asset funds, and the returns you just heard from him about. Vishal, having said that, my final question would be, if somebody were to be a long-term investor, and I know it will always differ depending on the risk appetite, the time horizon, so on and so forth, but I'm giving a basic piece out here that it's an average risk investor at an average range with an average earning cycle and a reasonably long-term time horizon in mind, what would be a good category if this person is wanting to start investing in the mutual fund space?
So if you're starting to invest in the mutual fund space, I think the hybrid products probably is a great way to start. Like we discussed, being purely in equity can be a very attractive way, just because when you look at past market behavior, it looks, like you would have made more returns. But you have to be cautious. You have to hold on for the long term and be prepared for the downside as well. And wherein hybrids have generally been a great source of balancing risk and return. The other way to think about it is that if longer term you can be, based on what you're, you said it's an average investor, you are willing to hold on long term, etc. And what is your target asset allocation? And let's say your target asset allocation is 70% equity, 30% debt. Then choose a mix of products that can give you that allocation. The traditional balanced funds or the aggressive hybrid funds have been in that space, but there are other ways to make that allocation as well. And do it regularly through an SIP is again a great way to manage the risk better. So an SIP into your targeted asset allocation, whether it is through individual products or whether it is through a hybrid product, would be a good way to construct a portfolio. If you're a first-time investor and you don't really want to get into a lot of individual product selection, then choosing one or two simple hybrid products, including the one that we talked about, the multi-asset product, may be a good way to go.
Okay. Vishal, such a pleasure having you. Thank you so much for taking the time out and giving us your insights. Much appreciate your time today.
Thank you for having me. Great being on the show.
Yep. We're joined by Prableen Bajpai, founder of FinFix Research and Analytics on the show. Prableen, always good having you. Thanks for taking the time out. Good afternoon to you. I wanted to think about this, Prableen. So many people must be thinking of starting off SIPs at the current juncture in the new year, so to say, though we are already in May, but be that as it may. So for people who are not shying away from taking that call 20 days before the election, if I had to push you to recommend two categories of SIPs where you believe people can start off investing, what would those be?
Good afternoon, Niraj. Great to be on the show. I was just listening to your conversation with Vishal, and I guess multi-asset is a great category to start with for moderate risk investors. But if I have to pick two categories for investors who belong to the high risk appetite and do have, let's say, a 10-ish and plus horizon, then the first category would be a multi-cap fund. Multi-cap funds, as we know, Niraj, can invest into large, mid, and small cap funds with a minimum 25% allocation, and the remaining 25% is as per the fund manager's discretion. And why this category? Because I think it brings in the stability of the large caps, along with the growth potential that mid caps and small caps offer. And within this category, the fund that I like, one of the funds which I like is the Nippon.
Okay, I think we've just lost that line. We'll just get that going. I think she was about to start talking about the Nippon fund, but I think we just lost that line. We'll try and patch that quickly and then try and ask Prableen more about what it is that she was trying to say. Hang on for a bit. Okay, I think we do have Prableen back. Sorry, Prableen, I think we lost you. Can blame it on the internet.
Yeah.
But yeah, could you just,
Sorry.
no problem at all. Can you please finish your answer?
Yeah, so the Nippon multi-cap fund, Niraj, this is a very old fund. It's got a 20-year plus, 20-year, almost a 20-year track record, and managed with a a value and a growth strategy, a mix of the two. It follows both top-down and bottom-up approach at the same time. The fund has been able to participate in the market rallies as well as has been able to contain the downside. I think it's a good addition for portfolios where the horizon is long-term, because a lot of people don't go and individually pick a small cap right in the beginning or a mid cap. And I think this can be a decent start for any investor who has a long-term horizon, not for anybody who has, let's say, a less than 5 to 6 year horizon. And the scheme has performed well, with decent rolling returns as well as XIR returns in the last 5 years have been in, between 20 29 to 30% returns. So that's one fund. The second one, Niraj, is a passive strategy. I think passive strategies are again which are very useful for investors, especially who have a real long-term horizon, again exceeding 10 years and beyond. And within that, my choice is a mid-cap 150 index fund. So of course, within the passives, the fund house, we would want to choose a fund house where the tracking difference is the least. So we have different fund houses offering this strategy. And if you look at the past 10 years, Neeraj, the rationale for investing in a passive mid-cap fund is because only about 4 to 5 actively managed funds have been able to beat the index, with a substantial margin. So when I say substantial, 2% and more. So with a handful of active funds being able to beat the mid cap index, I think adding a mid cap index again is a good idea. You asked me to suggest 2 funds. If I had my way, then I would have added a mid passive large cap strategy as well. So a large cap passive or mid cap passive to complement it, a multi cap fund.
Got it. Okay, Prableen, thanks for that. Prableen, there are a lot of people who write queries to us. We try and answer some of those. For paucity of time, we'll probably be able to take 2 queries, but would love for you to try and help both of these gentlemen, I believe, into this. The first one is from Deep Sanbi. Deep is 31 years old. The goal is a lump sum return. Deep wants to create a corpus for his daughter's education. The daughter is 3 months old. And a retirement corpus of 2 crores, both of these over the next 15 years. His question is, he's got some investments. His question is, has he chosen the right funds for achieving his goals? Now, bear with me, Prableen, I'll try and tell you some of the investments that he has. He's got an SIP investment in Parag Parikh Flexi Cap Fund, 1850 rupees. Kotak Multi Cap Fund, about 1850. SBI Contra Fund, about 8050. ICICI Peru India Opportunities, the same amount, as well as Quant Large Cap and Mid Cap Fund, about 1850. Then he's got some others like Edelweiss Mid Cap, Edelweiss Mid Cap Momentum, Mire Small Cap 250, Nippon India Small Cap as well. So in all, about 9 or 10 funds. Now this is difficult maybe to answer at such a short go, Prableen, but based on whatever I've told you, is there any advice that you can give to Deep?
Right. So, Niraj, it's great that because his child is really young. So, education goal is really important with education inflation in India at about 10 to 12%. And, I think more than the funds, it's important if he's set a target for himself. So, let's say that today for his daughter's education, he would require about 30 lakhs. This 30 lakhs in the next 17 years at 10% inflation will become about 1.5 crores. So first, he really needs to set a target for himself. And for this, individually, he would require an SIP of about 23,000 per month. If I'm assuming an XIRR of 12%, which is slightly on the conservative side, but I think it's better because we really don't know, the uncertainties regarding taxation and other things. So I think 12% is okay. And second, Niraj, that for his own retirement, he set a corpus of about 2 crores. This corpus will only be worth about 83 lakhs in the next, this time period that he's given to us, 15 years. And if he actually wants inflation adjusted 2 crores, that means that he actually requires about 4.8 crores for himself. So that also needs to be recalculated. The schemes are okay. Already 9 funds, Niraj, an active passive in the mid and the small cap space. Rest, he's got a lot of active funds from the value and multi-cap and flexi cap. I think, okay, he can just continue with all of these, but there is just no need to add any other scheme in his portfolio. And maybe over a period of time, 1 or 2 schemes can actually be removed.
Okay. Well, Sanvi, I hope you got the advice and the rationale for that as well. And I'm certain this was helpful. The next query is from Brijesh Patel. Brijesh is age 33 years, Brijesh's query is, goal is lump sum returns. He says, I want to invest 5 crore rupees for the next 5 years and get 24 to 26% returns. What's the best course of action? Should he invest or should I invest in mutual funds or stocks or both? Prableen, tall target, 26%?
Yeah, and because he's asking that whether it should be mutual fund or stocks, I believe that he's not doing actively, like he's probably not managing too many stocks at present. So, Neeraj, it's great because we've seen in the last 5 years, if we look at the returns, we have been able to achieve this kind of returns, but that's mostly in the small cap space or, some of the funds in the multi-cap and sectoral funds. So firstly, that if we are able to create a portfolio like this, it would be a very, very high risk portfolio. Second, that he really needs to be sure if his goal can be extended. Let's say if markets don't favor, and what if we see something like a 2008 fall, and then for the next 4 to 5 years, it took time if you had invested at market highs to make very, very nominal returns. So I think first he really needs to be sure if he can extend his goal, and that can go up to, let's say, 7 to 8, 9 years, and not limit to 5 years, then it's okay. If it's a crucial goal, let's say some marriage or education or something very important, then I feel that he definitely needs to be sure about the kind of risk that he needs to undertake. And I think a moderate risk portfolio would be better with, funds categories like the multi-asset and probably more large cap tilted with a multi-cap fund to add, the mid-cap and the small cap to it. So the construct would totally change depending on, if there is rigidity in terms of the goal or not. But if it has to be a very high risk portfolio and he's okay to take that risk, then it will be a very, small cap centric kind of a portfolio with sectoral funds.
Okay. Okay. Probably just one quick personal finance question on a mutual fund show, but somebody brought this out. I'm just throwing this out of the dark at you. But somebody made this interesting point that everybody talks about keeping a contingency fund in a fixed deposit. If you have a credit card which has got a limit of 10 lakh rupees or above, does that serve as your contingency fund and you need not block your money in an FD, instead invest it, because at any point of time, even if you're spending the money on the last day of your billings or the first day of your new cycle or the last day of your cycle, you still get about 15 days to liquidate any other investment and pay the bill. So why bother with a contingency fund?
So I think, Neeraj, a simple answer here that of course this is a choice, and a lot of new age investors like to utilize their credit cards for various purposes. You can do that, but let's say that you have 10 days to then pay off that 10 lakhs that you have spent. You will probably liquidate one of your long term holdings because obviously you don't have anything parked for the near term or for the short term, and that means that you're also jeopardizing the whole process of long term. Maybe your retirement goal, maybe something that's for your child's education, something kept for your home, for buying a house. So why disturb that process of compounding? I think contingency fund, you shouldn't look at the returns. That's something which is very essential. You can keep it in an FD, an arbitrage fund, depending on what your tax slab is. But because this has to be even repaid within, even if you're using a credit card, I think that would kind of disturb your overall portfolio because something will be sold to cater to this. And if it's not in debt or a fixed income product, then definitely you are disturbing the whole planning process, probably for your long-term goals.
Okay, but if suitably chosen, who knows, might be an option. But it's a personal finance question, not a part of the mutual fund show. But somebody posed it to me. I found it interesting. Thought we'll kind of throw it out of the dark at Prableen. Prableen, thanks so much for taking the time out and being with us on the show today. Lovely talking to you as always.
Always a pleasure, Niraj. Thank you.
That pleasure was ours, and viewers, thanks for tuning in.